Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He was Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. I guess now that you've retired, you get to sit back and just enjoy the nice weather. Or are you still really just focused on these markets because Bob Hoy says he's glad to be alive now because it's so interesting?
Well, I'm not quite as old as Bob Hoy. I think he's actually 100 years older than me, and he's been a dear friend for most of those 100 years. But yes, I did retire from being in the brokerage business, but I'm still up before 5 in the morning. I trade my own accounts, and I want to continue to write a blog and do interviews like this with you, as well as other interviews that I do. So I'm not I didn't just stop working and started playing golf. I'm still very actively involved, that's for sure.
Yeah, I guess you found it a good habit to have.
It's just, I guess, what I like to do. I have a dear uncle who is a leading world authority, actually, on a very narrow subject, but he's 86, and he's writing 2 more books right now. He's probably done 24 books over his professional life as a professor. And he's kind of an inspiration to me. Like, you just, why would you stop working?
Well, I remember my dad, a heavy-duty trucking mechanic, worked till he was 79, and he only stopped then because he would lose more money to taxes than he would make. And I suggested to him, well, you could always work for cash, and the look he gave me was, no, he would never do that.
There you go.
Anyway, but he still loved doing what he did right up to the last moment. Victor, before we talk about specific markets, do we have a big picture view we should be taking a gander at?
Yeah, I think that's a good idea, because it's sort of like you develop as a trader. I will develop a bias, and kind of call it a bias if it's going against you, or you call it the courage of your convictions if it's working. But I think you have to, or at least the way I was trained, you want to have some sort of understanding of where we are in a cycle, where markets are relative to one another, because all of the markets are interconnected in some way or other. So, yeah, so my big picture view, I think, has been that we had this virus come along. It was absolutely a huge catalyst, like affecting everything. When I say the virus, I mean, the other things that go with it, not just the virus, but the lockdowns, the job losses, the stimulus, and all of that sort of thing. So we had at various places around the world, massive stimulus from governments and central banks. And I think what that did, this has been my view, that kept us from falling into a black hole of depression. But it did not save us from what I think will be some ongoing deflationary pressures from a recession, a restructuring of how we all work, how the economy works, the interaction between governments, central banks, and the rest of the world, and so on. We've seen I think a huge disconnect between Wall Street and Main Street. I think the past few months, certainly since the March lows, and maybe in building on the enthusiasm from those lows, that we've developed a risk-on attitude in markets that's been, manifest with particularly, stock markets going higher, and that's been a function of sort of like, the government or the Fed, has your back. And to some degree, I think the markets are whistling past the graveyard, to use that old expression, like pretending the problem's not there, with respect to the virus and the things that go with that, to political issues, to tensions between the U.S. and China, actually between the rest of the world and China, and the sputtering economy and that sort of thing. So we've got that disconnect, and I know we've talked about that in the show before. So there we are. My big picture view is we've had this risk-on mood that has, pressured or moved all markets, particularly, say, the stock market, maybe more than some others. And I think that's taken us to kind of a vulnerable place because of this whistling past the graveyard attitude. And that if we were to have some catalyst, could be any number of things, trigger a reversal in that market psychology, that risk-on psychology, we could see some pretty rapid moves across different markets.
Gold and silver have been on fire since their March lows, gaining about 40% for gold. They're making new all-time highs this week against the U.S. dollar. What are your thoughts on gold?
Well, gold's been spectacular. I guess we were at $1,450 on the lows in March, and we rang the bell. Actually, the December futures contract printed $2,000 an ounce here on Monday night. I should add that within 5 hours it had dropped $75 from that price, but it's bounced back a bit from there, or substantially from there. I mean, we're at roughly 1975 on the December futures as we talk right now. Last year's lows on gold were about $1,300. So, we've had a continuing run up here the past couple of years. I've been through this before. I was actively trading in the run up in the late 70s and into the 1980, 81 highs. Gold and particularly silver develop a fever almost of enthusiasm, and I should add also that the highs that we made back in, I think it was January of 81, roughly $850. If you put a present day value on that, we still haven't made new highs in inflation adjusted terms, even though we've made new highs in U.S. dollar terms, in nominal terms. Not to disparage it, it's been a spectacular run. I think with gold here we've had, it seems to me, I should even look at my charts here, but it's something like 8 or 9 consecutive daily closes higher. I think we've been up 7 of the last 8 weeks, and every month for the last 4 months, gold prices have moved higher. I think the story, the narrative, whatever, has been that, massive money printing around the world is going to debase the value of currencies and cause inflation. Therefore, you should have gold, and gold will be an asset that is nobody else's liabilities and all that. I've traded gold since the 1970s. I know the stories on gold, and I'm going to say, to be honest, I missed this run in gold, and that has caused me some consternation. I thought, how did I not catch this? I mean, one of my very dear friends, Martin Nierenbield, and I, we visit a lot. Martin's been very bullish on gold, very correct about it. And, when I asked myself, how did I miss it? I think it was the volatility, the chop that we had, where the prices could swing, $50 a day, just kind of had me shy about getting involved. And then as it started to race away to the upside, I couldn't bring myself to buy it and just watch it as it went away. Now, went higher, I should say. Gold's been very much in the news, and but as a trader, I've had to learn over the years to sort of forgive myself for missing something. Yeah, gold had a great move. I missed it. So what? The markets will be open again tomorrow. They'll be open again next week. One other thought that I had as to why I missed it was that I saw massive retail buying of gold ETFs around the world. And honestly, I just kind of hate to chase a market where it seems, the public is just beating down the doors to get involved. Something else that makes me a little not so much suspicious, but just cautious here, is I see two of the major gold stocks, Newmont and Barrick in particular, are right now trading at about the same levels that they were at in May when gold was $200, $250 lower than where it is right now. Now, I will allow that the GDX, the ETF basket of gold stocks, is up about 10% from the levels it was at in May. So it's kind of tracked gold as risen here. Now, why do I mention that about those two major gold stocks? If you were looking at institutional money, call it pension funds, that sort of thing, they are much less likely, if they feel as though they need to be in the gold space, to buy bars of gold. They would buy leading gold-producing companies. That's just kind of the way I think they think about the gold market. And it's interesting to see that those major mining companies, gold mining companies, have not been bid higher. There's probably some gold mining analysts that could, explain that to me and tell me I'm just missing something important, but that was just something else that made me shy about chasing it. And my overriding objective as a trader is to try to protect my capital, protect my mental capital as well as my, the money in my bank account, my trading accounts. And if a market is running away and I find that I want to chase it, I'm going, wait a second. Don't get pulled into that. Just let it go. There will be another opportunity somewhere. Specifically on gold, I think it's been very much tied to the decline in real interest rates, much more so than like over the years we'd say the number one factor affecting gold has been how the U.S. dollar is doing. The U.S. dollar is strong, gold is weak, and vice versa. The last 2 years or so, real yields have, I think, been much more highly correlated to the gold price than has the U.S. dollar. But even so, here the last, let's say the last 2 months even, the U.S. dollar has been weakening, so that's been another supportive factor for gold. Now, going forward here, I used the word fever a few minutes ago. I think there's risks here that we could see some very choppy behavior in gold. And as I said when I was giving you my big picture view, a number of markets have made a run kind of on the back of the stimulus from governments and central banks, and gold and silver certainly in that category. If there was something came out, some catalyst, I should say, that would trigger a psychological shift in markets, we could see this, could see a good chunk of this rally we've had lately in gold reversed. I think in previous interviews I've said with you on gold that I was maybe not enamored of it in the short term, but I could see where over the next couple of years or something, gold would do better. I still kind of have that attitude, but that's not the time frame that I trade in. With my trading, I'm looking at, what I think markets are going to do in the next couple of days to the next few weeks. So, to have an idea about where a market will be 3 years from now is almost useless information for my trading accounts.
We'll have more with Victor Adair right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Victor Adair. Victor, my previous interview with Mike Swanson, he said he was almost worried about what's happened to the U.S. dollar. It's falling against most currencies. Is that what's boosting the price of gold? Is it the U.S. dollar falling, and is it going to continue to fall?
Well, that would be a $64 zillion question, believe me. And the dollar has surprised me at that's the U.S. dollar index, kind of a basket of other currencies versus the U.S. dollar. It surprised me at how quickly it has fallen. Now, within that basket, the euro currency is sort of the main thing, and I think the euro, it's up about 10% from what I call, that is for like the past 6 weeks, the euro has gone up 6 consecutive weeks, about 10% from what I've been referring to as the Macron-Merkel Save Europe moment that happened in the middle of May. That's when they put together this plan that they would have sort of a pan-European debt issue and use that and take that money primarily to the countries like Italy and Spain that were really struggling to get their economies going with everything that had happened here since the virus came along. And that was a real magical moment for Europe. Like this was the first major step toward kind of a pan-European collective backing of debt, as opposed to each country kind of going their own way when it came to issuing sovereign bonds. Now, I wondered at the time if that was indeed a major moment, or that was more like, what the American football players would call a Hail Mary. You're damn near out of time and you throw the ball and hope the guy catches it, and if they do, then that's great, and if you don't, you were going under anyway. So far the market seems to embrace the idea that Europe is ascendant and America is descending. And that's how it's played out in the currency markets. And when the euro currency is rising against the U.S. dollar, and by the way, it's also been rising against the Swiss franc, rising against the Japanese yen. So the currencies all around the world have caught a bid against the U.S. dollar for the past, let's say a couple of months or so. I'm less inclined. I think the weakness in the U.S. dollar that we've seen the past couple of months is sort of also a subset of this risk-on psychology, that if there is, again, a catalyst that turns market psychology a little afraid, a little nervous, and capital seeks safety, the U.S. dollar will be bid, and some of the speculators and so on who have jumped into these trades where you're shorting the U.S. dollar and buying something else may want to unwind those trades. I think part of the rationale for selling the U.S. dollar is, the Fed is printing zillions of U.S. dollars and therefore devaluing the worth of a dollar. But I'd say, well, so the rest of the world's doing the same thing. So what about that? So I guess my base case is that the U.S. dollar has been hammered here because of this risk-on psychology. I think that the bigger risk here is that the move up in the other currencies against the U.S. dollars is at risk of reversing.
The Canadian dollar was down to around 69 cents back in March. It's now around 75 cents. What do you see happening with the Canuck buck?
Yeah, the Canadian dollar, as we've talked so many times on this interview, is one of the main things that affects the value of the Canadian dollar is how is the U.S. dollar doing against the rest of the world. And generally speaking, if the U.S. dollar is going up against the rest of the world, then it's going up against the Canadian dollar. So in this environment we've had here the past couple of months where the U.S. dollar has been weakening against virtually all currencies, and there's just a couple of exceptions really, the Canadian dollar has been rising. Now that 69 cent level that we hit back in March, as the markets had gone into free fall with the virus impact, that was an extreme, I think, for Canada. I mean, that tied a low that we made back in January of 2016, and the low we made at that time, January 16, was sort of on the back of crude oil having fallen from roughly $100 to $110 a barrel in 2014, all the way down to $25 a barrel in January of 16. And crude oil, as far as the market was concerned, was hugely important to the value of the Canadian dollar. So I think the low we made here in March in Canada. As you know, as also say the lows we made in the Australian dollar at that time, the commodity currencies generally were probably an extreme. But yeah, we have rallied back to about 75 cents. Again, as I said moments ago about the U.S. dollar, I think the U.S. dollar is eventually oversold here, so I would think that Canada is a little overbought. I think Canada struggles. When I say Canada, I mean the Canadian dollar struggles above 75 cents. I think Canada has also been highly correlated to the ups and downs of the U.S. stock market, the major indices, on a short-term basis, which would, again, go to my thinking about there's a sort of a correlated risk-on market sentiment that's affecting stocks, currencies, commodities, and so on. So, short answer, I guess, 75 cents. I'm more likely to be a seller of Canadian dollar than a buyer.
We'll have more with Victor Adair right after the break.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, you've mentioned a few times that you think we're in a strong risk-on sentiment in the markets right now. How do you see that playing out on the major stock markets?
Well, I think the U.S. stock market has been the epicenter of this risk-on market sentiment, whether or not that's the S&P 500 or the NASDAQ, and I guess at some point you've got to say NASDAQ because that's really where the action is with the concentration of the, I think we've got the top five stocks, and everybody knows, you know, it's the FANG stocks represent now 22% of the S&P. The market has been buoyed, without any doubt here, by this massive stimulus and thoughts of more to come from the government and central bank in particular. We have interest rates at ultra-low levels. And if that is the case, you know, what we call the Tina effect, there is no alternative. I mean, realistically, if you're going to get nothing for putting your money in a bank account, nothing for a GIC, nothing for buying a government bond, what are you going to do? Whoever you are, you know, it could be your individual or a huge pension fund. You're going to, I guess, look at doing something in the stock market in some form or other. And then as the stock market rises, we've got the FOMO, the fear of missing out. If you're a professional money manager and you just are going to sit in cash and the rest of the people that are competing with you to manage assets are making money hand over fist as the stock market goes higher, you get motivated to become a buyer yourself. And then, of course, maybe we can talk about this later, but there's also these millions of new retail online accounts that are jumping into the market, and they seem to be just buying accounts, just buy things that are going up. So, yeah, we have this risk-on sentiment. The stock market seems to be the heart of it, and as I said earlier, I think there's a little bit of a whistling past the graveyard attitude in terms of the risks that we have from I'm going to call it a sputtering economy, the spreading virus, tensions between U.S. and China in particular, the bickering that we have at the congressional level over a stimulus package, and then certainly, you know, political risks. So we've got a presidential election less than 100 days away, and also this concentration risk. Now, whether or not that's a big deal, I don't know. 5 stocks representing 22% of the S&P 500. But Jimmy, you know, it's summer, okay? We've got a momentum-driven market. It seems like you can't beat this market with a stick. The Fed keeps saying, you know, that they're worried about the sputtering economy, and what the street hears is, well, they're going to shovel more cash at us, so, you know, you don't want to be a seller of the market. I have traded this on balance, mostly from the short side the past couple of months. And I've made some money a few times, but on balance, I've been losing money by shorting the stock market because of this bias or this big picture view that I have. So my risk management overrides my bias. So I've lost a little bit of money. I'm puzzled by it. I notice when I talk to my friends and people, that I've known for years that are professional traders, a lot of guys seem to be something like me. They just kind of can't make sense of this. They are not aggressively buying everything with both hands, that's for sure. Maybe struggling to even show any kind of a gain in these markets. So there's a lot of suspicion, I guess, in the professional trading community out there that this thing has got legs, but at the same time, I think professional traders are guys that have been through it before, and when you're wrong, you throw in the towel so that you don't, you can live to play another day. So, yeah, I guess a bit of a ramble there, but that's what I think of the stock market right now.
Interest rates are at or near record lows. Do you see that continuing, and what does that mean for other markets?
Yeah, actually, I do. I mean, I kind of feel as though the Federal Reserve has their foot on the neck of the bond market. There's no such thing as bond market vigilantes anymore. And I'd love to be wrong about that. I mean, I think there has to be, as Stan Druckenmiller calls it, a hurdle rate. That money should cost something. So, you think twice before you borrow money to invest in something. And with real low interest rates and stimulus, I think it pushes people to reach for yield to get into things that they probably shouldn't get into, but they have to because they need the income. Certainly there's other things to do besides buying bonds, and in a way, you're running your own money. I mean, why would you buy the bond market and get nothing? You're going to try to buy some sort of a basket of stocks that gives you some safety in terms of they're not going to plunge to zero overnight and give you some dividend yield. Or, we're seeing money just piled up in money market funds. So maybe there's a lot of people that just say, I'm just going to do nothing. There's $15 trillion worth of negative yielding bonds right now. It would seem if the bond market was sending any kind of signal at all, if the Fed took their foot off the neck of the bond market would be telling us that the economy is really struggling here. So, yeah, I think interest rates stay low. I said earlier the correlation between rising gold prices and falling real interest rates, especially like at the 10-year tenor on the U.S. Treasury market, has been very strong. The real yield on the 10-year right now is nearly 1% negative. It's about 0.93. When interest rates are that low, people are going to look for other things to do with their money. There's no hurdle rate to taking on things, and when money is readily available or cheaply available, it gets poorly invested, and all kinds of bad things happen. But it is what it is.
WTI crude plunged to negative $40 in late April. It's been trading around $40 to the good side the past month or so. What do you see happening with crude?
This question keeps coming up, and I know I answer it this way, but I think it's been more of a lack of demand story rather than a supply story. Certainly over the last couple of years, the market's been absolutely focused on supply. The frackers are boosting American gross production. We got up above 12 million barrels a day in the United States. There's the OPEC and friends, OPEC and Russia are going to do this or that to control supply. But I think even the OPEC group numbers are showing that they anticipate that the average global demand for oil, let's just call it that, for 2020 is going to be about 10% below where it was last year. You picture there's less people driving, maybe less trucks on the road delivering stuff, certainly less airplanes flying around, I think their forecast for 2021 next year, the average global daily demand is still going to be at or below what it was last year. I think there's And there's a lot of thinking there that with these low prices, the markets are not replacing the barrels that they need for future sales. In other words, they're not developing inventory. They're not going out and finding more oil to replace the oil that's getting used. So that could set up a situation in a year or two where demand comes back because, I don't know, we got a vaccine and, everything is hunky-dory, whatever, that all of a sudden the world is demanding a lot of oil, but the amount of oil in the inventory is way low, and you have prices really jump because of that. But right in through here, I've got some trades on in crude oil. I'm using contango spreads, where I'm looking for the call it the time spread, or the yield curve sort of thing on crude oil. I'm looking for that to steepen, where the deferred months in crude will trade at a premium to the nearby months, and that would be something that typically happens in crude oil when prices are weak. So I'm a little bearish on crude, but trading it cautiously using these time spreads.
Before we wrap up, what do you make of the millions of new online retail accounts, the so-called Robinhooders, and are they having a big impact on the markets?
I think they really are having an impact. Just today, Kodak, Kodak, the old camera company. Remember, your grandma had a Brownie. Kodak's been trading between $1 and $4 a share for the last 2 years. It exploded to $60 a share this morning. There was apparently, and this was partway through the morning, it's probably a lot higher now, but there was something like 45,000 Robinhood accounts had bought some Kodak. But we're also seeing from these new retail online accounts, and they've been involved in Tesla and any number of other stocks, and they've been nailing it. They got to hand it to them, and good for them. But in terms of the signs of maybe some froth in the market, there's been massive buying of out of the money calls. That's, let's say you've got a stock that's trading at $90 and you can buy an option that expires next Friday on a $100 strike. Okay, so that option is going to be worth absolutely nothing if the price of the stock doesn't go up more than $10 between now and next Friday. So that's what I mean by massive buying of short-dated out-of-the-money calls. I think all of that call buying is really having an impact on the put-call ratios. I see a number of people point to this. The ratio of calls relative to puts that are being bought is at extremes. And it makes you think that this is another way to get leverage in the market. These online retail accounts, I think, are aggressive buying. I think they've certainly been in the gold market and silver. They've been also in the currency market, buying other currencies against the U.S. dollar, copper market, lumber market, Tesla, as I mentioned. I think there's a pattern here, and the pattern is that these accounts are buying things that are going up, or there's kind of a group a feeding frenzy, and they'll jump into stocks. I know I've talked about this with some of my friends that have been around trading for years and years, and we're all kind of expecting that at some point, these folks will buy a market that dips, and then it'll keep going down, and then what do? Maybe they just say, oh, well, I'll hang on to that because I know it'll get better. I think they're probably going to get severely tested at some point, and believe me, I don't want to wish bad luck or money losses on anybody else so that I can take their money. This is a free market to get in and trade, and if you don't have to participate, you don't want to. But I think a lot of this, these new folks that have come into the market, like us, when I was 30 years old, I traded very aggressively. Now that I've had 40-some years of experience, I trade a lot less aggressively. And I guess the wrap on that, Jimmy, is that there are old traders, there are bold traders, but there are no old, bold traders.
They say the same thing about pilots.
Yes, I bet they do. So, to me, as you've heard me say so many times, having a great crystal ball is nice. Having a real process to develop your trading strategies is great. But the thing that keeps you going is how you manage your risk. And I'll just wrap it up with this. An old friend of mine who worked at the same company in Chicago that I did back in the 70s and the 80s, been writing a newsletter for years, and he was saying the 80-20 rule really kicks in. He's made, in his 40-year career of trading his own account, he's made 80% of all of his profits have come from just 20% of his trades, and actually the numbers even are more dramatic than that. But the one that really caught my attention is he said that he made 85% of all of his profits in only 15% of the monthly periods over that 40-year chunk of time. So what that meant was, on average then, less than 2 months of the year is when he made his year. So he said the important thing is, what do you do the other 10% of the year? And I took that to mean, for crying out loud, be careful. Don't just do something, so that to be busy. You really have to protect your capital in those times when there's really nothing to do.
Victor, thank you so much for chatting with us.
Jimmy, always look forward to it. Thank you. It's been a pleasure.
My guest has been Victor Adair, co-founder of the Polar Futures Group. He was the Senior Vice President and Derivatives Portfolio Manager for PI Financial in Vancouver. If you have any questions for Victor or any of our other guests, you can send them to info@housestreet.com, our YouTube channel, Talk Digital Network. You can also find us at House Street on Twitter and also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.